Today, last minute, we're doing this, the long-term care class or training. Franny, can we do, is that guy on at 10:30?
No.
Okay, all right, so, all right. Perfect, all right. I just don't know how much time. So guys, long-term care, before we go into the different product types and options and all of that stuff, what is long-term care?
Earmarked for long-term care when you can't take care of yourself. You can't do 2 to 6 else.
Right. So it's money that's there that you're offsetting or changing the financial burden from yourself to an insurance company to pay for the cost of care. Cost of care can be where? In your home or in a facility. It's disability coverage, and just to kind of, again, disability coverage is replacement of income or earned income to a degree. So if I become disabled and I can't do my job, I'm going to receive X amount of dollars, let's say $5,000 a month tax-free, until I get better or until I reach age 65, 67, or 70. Hypothetically, I have a disability policy, right? My household starts receiving $5,000 a month tax-free after 90 days of being on claim. And let's say I needed, God forbid, a home health aide to care for me or a facility to care for me. Would my household receive the $5,000 coming in, as well as if I had a long-term care policy, the nursing home or the home health aide being paid? The answer is yes. So one has nothing to do with the other. One is I'm having replacement of cash flow into my home in the event that I couldn't do what I do for work. And the other is that I've got cash to an extent that the insurance company is going to either pay for the facility and or a home health aide, depending on what my needs are. All good? So if I have a long-term care plan, typically, Francisco's already said it, what are the triggering events? How do I know disability? If I get disabled mentally or physically, I go to the doctor says, Dustin, can't do your job anymore. You're disabled for a time being, right? I file a claim with the insurance company and then they start paying me or they ask questions and go through the claims process. Long-term care, I have the policy in place, and then what happens? How do I trigger it? Right. Right. So if I can't, 2 of the 6 acts of daily living are what?
Transferring from a bed or a wheelchair.
So mobility, right? Feeding myself. Bathing, using the restroom, toileting. We will pull up an illustration, but it's I can't wash, use the restroom, move from place to place, feed myself, and I'm not mobile, and or to Frank's point is cognitively, it's not and, it could be or cognitively they're not there. Okay? If that occurs and I need a home health aide to come into my house, I either pay with my own dough or policy kicks in. Okay? And guys, keep in mind a lot of times, and probably unfortunately all of us and some of you have seen this in your own lives, a lot of these things are not triggered where all of a sudden a person needs 24/7 care. It usually doesn't go from 0 to 100 overnight. Usually there's something that triggers that a person needs a little bit of care throughout the day or a few times per week. Right? Somebody, they slip, they trip, they need a hip replacement, and now there's a downhill snowball effect. And depending on an age, and it doesn't have to be somebody that is old, right? It could be somebody that's young that has a triggering event that needs care. Okay?
If the person have Medicare or Medicaid,
How
Great.
much trigger?
Great question. So his question was, if a person has Medicare or Medicaid, doesn't that, or not doesn't it cover it, but I'll say, doesn't it cover it? Medicare will cover the first 20 days of a long-term care claim. So 0 to day 20, Medicare covers 100% of the claim. Day 21 to day 100, Medicare will cover a certain dollar amount per day, and every year this number goes up. I think today the number is like $180 per day. I don't know what the number is today, but that's from day 21 to day 100, and then day 101 and beyond, Medicare covers how much? 0. That is the case. Now, Medicaid is you can't have any assets to your name, right? Or you have to have a very, very, very nominal amount of assets to your name. I think the number is actually $2,000. Okay, so it's not meant for people that have money. This makes sense? So Medicare covers 20 days, 100%, 21 to 100, a dollar amount per day. Why the dollar amount is really irrelevant is because if you're speaking with somebody that's 50, 60 today, typically by the time they go on claim, this dollar amount will go up because of inflation, etc. And really what we're always solving for is if they're so lucky to need the care beyond that. Okay, 101 and beyond, nothing is covered by anyone. Okay, and if somebody happens to have no money and they end up in a Medicaid facility, I'm not sure that that's really where they want to be, right? Because of the type of care, the type of facility, and that sort of thing. You guys all familiar, right, with what we're talking about, or not? Yes? Okay. Cool. Few ways to do this, right? So what's way number 1 to pay for care? Yeah. Way number 1 is your own money. You got money, you can self-insure or pay for whatever the care is by yourself. If the average cost today, just to make it simple, is $200 per day, and there's 30 days in a month, a person has to spend $6,000 per month in order to pay for the care. Times 12, that's $72,000 for every year they're on claim. So if they're on claim for 1 year, 72. They're on claim for 2 years, that's 144. They're on claim for 3 years, that's 226. Did I do that right? Mm-hmm. And so on and so forth. I didn't do it right? Say it again? They're not on claim, right? They're not on claim. They're using their own money to pay. So somebody can do that, but does it make sense, right? What are you saying? That's right. I was 280. I knew the math was wrong. 288, not 266. Okay. Number 2 way is going to be, I call it standalone long-term care. As an example, Mutual of Omaha is got, for the last several years, I would say the most competitively priced standalone long-term care benefit. Instead of me drawing it out, let me pull it up for you guys so you can see this. So this is an example of a husband and a wife, and you could see age 53 for the wife, 54 for the husband. And we're showing Mutual of Omaha and then National Guardian. How this works is, for this gentleman, he would be paying $232 a month for his plan. She'd be paying $381 for her plan. So combined, that comes out to, I don't know, whoever wants to do the math. Six what? Oh yeah, $614 a month. Now, what happens is each of them in this design, right? In this design, he has $4,000 per month to use for care. She has $4,000 a month to use for care. And they each collectively have a bag of $150,000 of money. So you buy this long-term care policy today, you decide and you agree to pay $614 a month. So $614 a month. The husband, the wife, $150,000. Combined, they have a $300,000 pool of money for long-term care immediately, because there is the risk or the chance that, well, they go on claim sooner rather than later. Now, this is, they're paying for life, and you'll notice here that HHC, home health care, it's covering 100%, or ALF stands for assisted living facility, it's also covering 100%. So there's no difference on the type of care that they're receiving, whether it's in-home or in a facility. The benefit is $4,000 a month per person. And this kicks on after 90 calendar days. So just like disability, in this example, there's a 90 calendar probationary period. Does that really matter? Why? Medicare will cover, right? We just said day 21st, 20 days, Medicare covers 100%. Day 21 to day 100, Medicare will cover a certain dollar a day. And day 100 and beyond, you're on your own. So even here, as we would probably start this day 100 and beyond, okay? Now you'll see it says in this design, waiver of elimination for home health care. So if in this case, in this example, if they went on claim and it was in their house, there is no 90-day probationary period, but it would be in the best interest of the client to take advantage of Medicare first, deplete it, bleed that down, and then to use their bag of cash. With this plan, if they go on claim, if he goes on claim first and he uses $2,000 per month, how long will the benefit last? 6.2 years, right? So you can use less, you can never use more. So if the client needs to use less than $4,000 a month, they can use less. They're not forgoing the money, they're just allowing it to last longer, right? If they have, if the cost is $6,000 a month, where do they have to come up with the other two? Their pocket, out of their piggy bank. Now let's say he goes on claim first, and he uses $4,000 a month, right? $4,000 a month, $4,000 a month, $4,000 a month, and he uses the 3.1 years of money. So he exhausts the $150,000. In this plan, he can use her bag of cash before they start using their own money, and vice versa. So if she goes on claim, she exhausts her $150,000, she can use his bag of cash before they use their own cash. So the bottom line is you can $0 to $4,000 per month in this design, and you can use the $300,000 until it's exhausted, and then you got to go into your own piggy bank. In this type of plan, I call it again standalone long-term care, if the client cancels it, do they get anything back? No money back, right? So it's like Geico auto insurance. You don't get into a car accident, no money back, which is a good thing. Yes. Well, yeah. If they die, is there any money back? No. No money back if they die. And is the premium of 614 in this example guaranteed to stay fixed for the life of the contract? No. On standalone long-term care policies with every carrier across the board in the country, the company reserves the right to increase rates on a class basis. They can't just say, Frank, I don't like you today. We're going to leave Sapphires at the original premium, but Frank, we're going to increase yours by 30%. It can't happen. So they can increase premiums, but how insurance companies do this, it's not like, okay, Adalberto and I are executives of an insurance company of Mutual of Omaha. We say, you know what, today we want to screw all of our policyholders and we want to increase their rates by 30% to existing policyholders. Is that allowed? No. We have to sit and make a business decision. Does this make sense? If it does make sense, we've got to file the increase with every state, and every state will then either approve or deny. If they deny, can't be done. If they approve, it can be done. Okay, and over the last 18 years of doing this on standalone long-term care policies, I've seen every carrier increase at least once to the tune of 10 to 15% is roughly what the increase is. Okay, don't hold me to it, but that's what it is. Now, the other thing is once they exhaust the bag of $300,000, what happens? They're out of the insurance company money. Now they got to go into their own piggy bank or their own pocket. So over here, this is going to be a little bit less expensive than the next two that we're going to go through. But if you die before claim, zero death benefit. If you cancel, zero money back. Cost can increase again on a class basis, and once use the bag of cash, you have to use your own money. And yes, correct. And the if the person goes on claim, premiums stop for both parties. Yeah.
Husband dies, but the wife lives. Does she get the 150?
No. Nope. Now, one of the things that you guys got to get good at doing is objectivity. Some people will say, if I'm going to spend $615 per month on an insurance policy, why not put that $615 a month into what? What am I thinking? No. What if I just save it? What if I just invest it? Or what if I put it into a life insurance policy? But the thought is, if I save $7,200 per year, let me just show you guys the math, and this is what you guys got to do, in my opinion. It's what I do. Is if they're going to save $7,200 a year, if they save $7,200 a year and they had a return of 6%, could be in a brokerage account or whatever it is with us on their own, it would take them 23 years to get to the $305,000. It would take 23 years. Okay. That's insurance way number one. Regular way number one is not insurance way, it's just pay with your own money. The other way to do this is going to be, and I'll use this as an example. So is going to be an IUL with an LTC rider. So as an example, Mutual of Omaha has it. Lincoln also has it as well. The person says, I want to get a $300,000 death benefit. They're eligible to take, and they got to do this when they underwrite the policy, 1, 2, or 4% of the initial death benefit for long-term care purposes, and that's per month. So as an example, I typically build it on a 2% number. So if the person goes on claim today, this individual has $6,000 per month until they exhaust the $300,000 death benefit. It's not the cash value that they're exhausting. It's the death benefit. 50, 60, whatever the age is, I say, give me $300,000 of insurance. On that insurance, I want to add a long-term care rider that if I go on claim, I'm using 2% of the death benefit. So 2% times 300,000 is 6,000. 1% is 3,000. 4% is 12,000. When they buy the policy, they're selecting what percentage of the death benefit they want to use for long-term care purposes. If they decide to use 2% in this example, they're receiving $6,000 a month from the time they go on claim until they use up the $300,000. Now let's just say the policy grew, meaning that there was cash value. So you started with the death benefit of $300,000. The cash value is worth $100,000, and your new death benefit is now $400,000. What's the long-term care based off of? Which one? 4 or 3? It's always only based off of the initial death benefit. Now, if they use the $300,000 for long-term care purposes and then they die, guess what happens? Family gets the other $100,000. But for long-term care purposes, they can only use the percentage is only off of the death benefit. Have nothing to do with cash value. There could be zero cash growth from now until the cows come home. Doesn't matter. You're still getting 2% of the initial face amount to use. Over here, right, is this cost fixed? Yeah. The cost is fixed on these products, these two carriers. It's a guaranteed minimum death benefit until age 90, which means that if the market never performs positively, if there's never a year of positive performance, by them paying X dollars a premium, the insurance will last till age 90, right? So it's a fixed cost. You've got guaranteed minimum death benefit until age 90. I'm pretty conservative, but even I will assume and think that there's going to be some year that there's going to be positive growth, right? Is there a death benefit if they die before using it? Yeah, we already know it's going to be a minimum of 300 all the way up to whatever the cash value is. So there is a death benefit if not used or any unused amount. Is there a cash surrender value? Depends on the cash value of the policy, but with Mutual of Omaha, I'll show you the illustration in year 15 of the policy, and in year 20 through 25, the client has a guaranteed refund option. So if they want to exit the policy and they say, you know what, the heck with this thing, I'm going to roll the dice, I want my money back, they get their money back. Okay? And there's no cost to that. So how that works. So what I did, can you all see this in the back? So this is an IUL with Mutual of Omaha, and it's their what's called the life protection advantage. It's not the income advantage product. The income advantage also has a long-term care rider, but it's meant for what? More for income and cash. This is somebody says, you know what, I want permanent death benefit, and most importantly, or just as important as I want long-term care benefit. So he's 60 years of age, male preferred non-smoker, and he says, I want $300,000 of insurance. You've got 3 columns, just like you have in any IUL. Guaranteed means 0 market performance. Assumed is showing a 3.25%, and then non-guaranteed is showing a 5.51% positive performance from, let's say, S&P 500. Okay. So as an example right here, let me go up and then we'll go back down for a minute. It's usually page 7. Nope, it's page 15. So over here it has what is the long-term care rider. 300,000 is the max limit. Monthly acceleration 2%. They get $6,000 a month until they use all of that. Covered long-term care services are those things. And there is a 90 calendar, again, day elimination period.
Is that $300,000 limit because this is a $300,000?
Yes.
And so that changes if you.
Yeah, so if we did a $500,000 policy at the same 2%, what's this number going to be? 10K. It's all so why they do the 1, 2, or 4? You know, let's say the person had $1 million death benefit. Maybe they just do 1% and it's $10,000 per month. Or they really could also separate policies as well, not to be too crazy, but you can do one strictly for death benefit and then the other one strictly for LTC purposes. Because there is a cost for the rider. There is a cost for the rider. What is the number? I don't know. I don't know what the number is. It probably says it in here somewhere. It says it here. Cost per rider is 20 cents per $1,000. So one of you guys could take the calculator and figure it out. That's what it is.
Does that go up or was it fixed?
Yeah, it's fixed. Guaranteed monthly cost.
So what happened when they go on claim? Do they stop paying the premium?
Yes, sir. Yep.
So if they take it for this moving forward, so it only be lasts for 4 years or something. The 6,000 out of the 300K death benefit will only last for about 4 years or so.
So you're saying if they went on long-term care claim and they use the $6,000 per month, right? It's gonna last actually take 300,000 divided by 72,000. 300,000 divided by 72. It lasts them 4.16 years.
And then when they're using that claim, the policy will not allow.
Correct.
And the money doesn't roll. So if they don't use all 6,000, it's use it or lose it.
No.
So if they use 3,000.
If they use 3,000, it's going to last 8 point. Yeah. Same. It's not use it or lose it. It's you have a bag of $300,000 to use for death or for long-term care purposes. If the maximum that they could use here is 6,000 per month, if they use 3,000, it lasts double the length of time. This is a built-in feature. I like this. Why are you laughing?
Everybody would.
Yeah, I would too.
This is Mutual of Omaha has it. I mean, if the market performs at all, it's irrelevant because there's cash value. But I like this concept of it because it's for worst case scenario thinkers, right, Paul? So worst case scenario thinkers is in year 15, they're guaranteed to get 36,000 back if they want to exit the policy. In year 20, they can get 97,000 back. In years 21 through 25, they're able to get those stated amounts back if the market never performs, and it's guaranteed. There's no additional cost for that. if anyone in their right mind thinks that there's ever going to be positive market performance, this is an irrelevant factor. But again, it's a nice feature, selling point, whatever. You guys don't have to remember year 15, years 20 through 21. It has it on the here, guaranteed refund option. And it also has it where I'll show you guys here on the illustration. So it says in year 15, guaranteed refund, year 20, guaranteed refund, years 21 through 25, guaranteed refund.
This IUL a flexible premium?
Yeah. Yeah. All of the, every IUL is flexible in payment. This one, there's a no lapse premium. So as long as that no lapse, that's how I designed it. So as long as that no lapse premium of,
405 is a no lapse, right?
that's a no lapse premium. As long as that 405 per month is paid, they're guaranteed to have that 300,000 till age 90, even if there's no, I mean, you could see it, even if there's no market performance. Now, if they want to put more, can they? Yeah, they can. In this type of design, I wouldn't fund it with more personally, but they could. Question.
Is this more expensive for a woman compared to a male on the long-term care option, or no? Because on the life insurance is cheaper for men than a female.
My assumption, so the life insurance portion is going to be cheaper for the female than the male, but the long-term care cost of the rider will be more expensive for the female than the male.
Because they live back more.
Right.
So it's not a fixed rider cost.
It is.
Policy.
Yeah, well, no, it's not. So you don't have to put it, you don't need to have the long-term care rider on there.
0.2014 per thousand is not fixed. It depends on the actual.
Correct.
Right.
It's gonna be based on the rating, the age, all of that stuff.
Is this a harder plan to qualify for when you
No.
have the long-term care rider than a normal life insurance?
No, but there's a cognitive element that they have to be approved for. No different than any other long-term care policy. No
But
different.
it does carry approval for the long-term.
Yes, correct. Just like One America, just like, yes. I mean, if somebody's gonna, I shouldn't say. Yes, there's approval. Let me just leave it as that. Any questions on that? What were you saying? Okay.
It's not going to be tax qualified.
No. So kind of going back a minute to Frank's point, this 614 on that standalone LTC plan, a portion of that premium is deductible based on their ages. Have nothing to do with being a business owner, just has to do with being an individual at a certain age. They can, if you guys have the 2023 tax guide, on the back of it, it says for long-term care benefits, what's deductible. It says it on there. The middle, the IUL one is not, there's nothing that's deductible. The next one I'll share with you. Any questions? So we can go back to this in a second. Frank's case. Okay. So I showed this at the kickoff meeting, but it was obviously too small and too many people in the room. This is One America, and this is asset-based. So it's One America makes it, and it's called asset-based long-term care. Forget the right side for 1 second, the red. Let's just focus on the blue, all right? So this is an example for a husband and a wife, age 60. And guys, obviously we can design this however we design it, all right? But it's husband and wife age 60, and in this design, they're paying premiums from age 60 through age 95. They could do single premium, they could do 5 pay, they could do 10 pay, they could do 20 pay, they could do pay till age 95, completely up to them. In this example, in the blue, it's pay till age 95. Husband 60, wife is 60, and their premium is going to be $10,413 a year combined. So it's not each, they have a combined policy that they're paying $10,413 per year for. Of that, $7,136 is long-term care and $3,277 is life. So to Frank's point, is $7,136 is eligible for deductibility when they do their taxes. If they were to surrender or want to surrender the policy, these are the values that they're able to get if they cancel the policy. Clearly, for the mathematicians out there, this is a shitty investment if that's what they wish to do, right? Just you could do the numbers and it's stupid, but it's a way that they can get money back. There's also a death benefit. This is built on a second to die whole life chassis. So this death benefit is only paid upon the second person dead. So if, let's say, husband goes on claim, he at age 80 goes on claim, he's going to get $7,014 per month for as long as he needs the coverage. The wife also will receive in that year $7,014 per month, so they have a combined bucket of $14,028 as a couple to pay how long? For an unlimited amount of time if they're so unlucky that they need to use it for a long period of time. So the key factor here, guys, is the way that this is designed, we have it keeping pace with inflation at a level of 3% per year, and each of them are eligible for that bucket of money that year. Let's say husband goes on claim, it doesn't matter, he uses $100,000 worth of long-term care benefit. The wife dies 1 week later because she can't live without him. There's going to be how much of a death benefit? $33,000 would be the death benefit. She died.
You said he went on claim.
Oh, sorry. He goes on claim. He uses $100,000 worth of long-term care. He dies. She dies a week later because she can't live without him. There's $33,000 that's then given to named beneficiaries. So any unused bag of 133 after both die go to the named beneficiary. Say again?
They cannot outlive the death benefit because it's
They can.
Yes. Can or cannot? Can?
Can.
Yeah, so if to his point is, if let's say they use $500,000 worth of long-term care benefits, whether it's him or her or both of them together, whenever they're both dead, how much death benefit is there? None. The only time this is a death benefit is, there's anything paid, is if there's money left over. Guys, this is fixed cost. They're guaranteed to never increase premiums. The company cannot increase premiums. And the other biggest component of this is this. That right there is the biggest component of this whole thing, is an unlimited benefit. Lincoln has a plan called Lincoln Money Guard, which acts like this, except it doesn't have an unlimited benefit plan. It's limited. So to me, it's very simple. Pay with your own money. You want a cheaper plan, that's the way to go. You want to do that, it makes sense for some people. And then this one is purely for worrying about long-term care. Because they get to, Trish, what do you call it? Use it. So if they live, this is what they get, which is shitty. They die, No, if they live, is that how you do it? Live, if they go and claim, that's the amount that they each get. If they die, that's what they get, or the family gets. If they quit, that's what they get. Quit the policy. Quit. Live and go on claim. Die and don't go on claim. Quit, give me my money back.
Does the monthly benefit doubles? Let's say the husband passed away without going on.
No. Good question. No. Good question. You've been eating your Wheaties lately, man.
Nor can they use that if they.
Correct. And neither can they use each other's pool of money like they can in the standalone long-term care
But it's
policy.
unlimited.
Correct. Correct.
But if the
So,
wife's care
but
costs
once-
10,000 a
once
month
of
and the
them
husband's
go
care
on
costs
Premium
2,000
stop.
a month, you're
No.
not sharing it back.
The other one already also start to receive benefits.
No.
No?
If the husband goes on claim and the wife is fine, the husband's policy is triggered, meaning the company is paying the premium, the monthly benefit, but there's no money coming in for the wife. She's fine.
At what point do
She's
we
going to
stop
Bloomingdale's, Nordstrom's, shopping, brings her husband a little McDonald's, then goes back out shopping. I'm just kidding. What?
Is that what you envision your life looking like?
Hell yeah. I mean, what else are you going to do?
Premium stop.
I'd rather just die than go on claim, but that's a different story.
We'll make sure Melissa knows she's got to bring you McDonald's.
Premium stop. If either one goes on.
Yes.
Now, this illustration is showing both of them the same age.
Right.
If there's an age difference, then the benefit difference.
There's no benefit. Well, there's a premium difference. So Nadine in West Palm had a client where who the hell did it? Lisa had one. There was an age gap of like 7 years between them, but it still made sense. Over here, as an example, this is 10,413 premium, right? They're age 60. So is there a premium difference if the husband is older or the wife is older? And the answer is yeah. There's a what's the difference? I don't know. You got to run the illustration. But this example is we just did this. I did this with Larry Schwartz's client. So this is now their age 60, 61, 62. And again, guys, this is what you got to get good at showing people, because the people that are going to look at this not are always that smart, but a lot of them will think that if I save the same money in a CD, in a money market, in a brokerage under my mattress, what is that? Why wouldn't I just save it? So if they're saving here $10,413 per year, at age 80, they will have then saved, they'll have $381,000 worth of money. We said at age 80, they each have $7,014 to use. So $7,014, they each have $84,000 of cash to use if they were to go on claim in 20 years. And if you took, it takes 2.2 years to exhaust. No, did I do that right? No. Hold on a second. And today my head is 8. In 4.5 years, they've depleted their cash.
For one of them.
Correct.
For one of
Well,
them.
however correct. If one of them went on, to her point is correct. If only one of them went on claim, it's going to take 4.5 years to deplete the bag of cash. If it's both of them on claim, it's obviously it's
And that's
quicker.
assuming 6% a year every year
Correct.
for 22 years.
Correct. But when we show this to the business owner, he's like, okay, forget that left side of self-insuring. Just let's do the wife. We went through option 1, which is self-insure, option 3, and option 4. The wife said, give me option 4.
Plus, that's also assuming too that they don't go on claim until age 80.
Correct.
Which you have to explain to your clients. you make one payment and you have leveraged the full weight of this policy. You make two payments, you
Right.
have leveraged the full weight of this policy. In your theory here, you have to save for 21 years to get that bag of cash.
And the other way to look at this is if you take $10,413 times 20 years, they've spent $208,000 in premium. If one of them goes on claim, it's going to take $2.4 years to hit that number.
They both go on claim.
Right, it's correct. And if they go on claim sooner, to your point, it's obviously much, much sooner.
I always ask this and I always forget. Are they able to bounce on and off claim?
Yeah. Guys, this is paying with till every year till age 95, right? They could accelerate it sooner. The other way to do this is take and pay with a single premium, but you can do it and they can do it. Now your heads are going to start to spin, so we'll take a little bit to go through this. But you use qualified money. So if you got a husband and a wife or same-sex couple, doesn't matter. It's recognized that as long as they're legally married. They have $1 million, $2 million in their IRA. They take $100,000 from the IRA and put it into a One America IRA. In the client's mind, the policy is paid. Every year for the next 10 years, One America moves from the One America IRA, $100,000. They'll move $12,500 per year to pay for the LTC premium. It's an internal thing. When the company does this, this was IRA money. They move from IRA money to what? To non-IRA money. They have to pay tax on $12,500, so they'll get a 1099-R at the end of the year for the $12,500. How much did they put in? If you take 12,500 times 10 is how much? Is $125,000. They received the 25% bonus from the company that theoretically is used to offset the taxes that's owed. So if they got a 1099, which they will get for 10 years, and they're at a 20% tax bracket, they actually made 5% on their money. If they're at a 30% tax bracket, they're only paying 5% on that money.
Does that count as a R&D?
Yes,
But they're still paying tax on the bonus.
of course. But it's still, if you're looking, I understand what you're saying.
Yeah.
And after 10 years, which really after 1 year, the policy is paid. And in this design, what we have is basically a lower amount. But by year 20, they have each have $4,200 to use for long-term care for an unlimited period of time. We did several cases like this in the last couple of months, I was going to say.
If they go on claim though in year 5,
They're going to still do
they
it.
still pay.
They're going to still do it. Yeah.
What if they die?
And that's the death benefit amount. If they put 100,000 in and they died day one, that's what the number is.
But then
And the same, what?
the family there's
Gets
gotta be
168 tax.
There's tax implications.
No, it's
for
not.
the estate on that 100,000.
This is a whole life. Second to die whole life. No.
But the tax hasn't been paid on the IRA that paid for that whole life.
There's probably some internal thing.
I would think there would have to be.
Right. This is finding the money for the client literally is moving 100,000 in this example from their IRA, that they wanted to do a Roth conversion anyway and pay for this, and they don't have to pay any premium. One of the clients we did this with, actually with Nadine, it was their husband and wife. One was 70, the wife was 72, husband was 68, 67. Got remarried to each other later on in life, very recently actually, and they were insurance underwriters, life insurance underwriters. There was no relation. We didn't know them prior to, but that's exactly what they went for. They used her IRA money to pay with it. To Frank's point, any money coming out of a qualified plan is going to be used for RMD purposes. It doesn't matter what you're doing with it after. If I have 4 different IRAs and I'm dispersing money from them, I'm taking income, but I'm also paying tax on the income. I will then have met my RMD number as long as I took the money out from those plans.
But there's another way to use an inherited IRA to do the same thing. Because the inherited IRA
Correct.
rule is now a 10-year disbursement, right?
Yeah, I don't know. So to do this single premium with qualified money, the person's got to be over 59 and a half. Can you do a single premium with after-tax money? Yeah, you could be 40 and do it. It doesn't matter. But to do a single premium with qualified money, you got to be 59 and a half. I'm not sure, is this plan inherited IRA friendly or not? I don't know.
I'm pretty sure when I heard him speak on it,
I'm not sure.
it is.
Okay.
That's a concept.
Okay.
Concept.
You guys all understand that? But the person inheriting has to be over 59 and a half. No?
No, inherited IRA money has to be, the tax on inherited IRAs, you have 10 years.
10 years
pay.
to do it.
Doesn't matter how old you are. when
But
you
will
inherit
that
it.
plan, it'll qualify?
Yeah.
Okay. If that's the case, then that's a kick-ass plan. Or concept. Any questions with this? So this plan, I'm going all over the place, but here you have fixed cost. You could do single pay up to age 95, up to them. You have unlimited LTC benefit, and it's either at death, cash surrender value, or for long-term care purposes. And to me, the factors are the selling points is the fixed cost, and then the selling point is also an unlimited long-term care benefit.
Also, that your money's not going into income, so you're gonna get some kind of benefit.
Correct. Correct, and that's what that is.
That's why it's great for those people that are familiar with, and think about it too, as you have a generation of baby boomers that are moving into the sector of receiving long-term care and their kids providing care. There may be some policies out there that they think they understand how this works, and things in the long-term care
Right.
world have changed significantly over the last 5 years. So that's why it's important to know what their options are. And this unlimited benefit is huge.
When I started in the industry, these plans, MetLife, John Hancock, Genworth, all of those companies offered unlimited benefit options. And over the last, I want to say 10 years, the companies phased it out. Why? Because it's a costly product to the insurance company.
What is the limit age for insurability here?
I don't know. I don't know, only because there's 3 different concepts we're going off of, and I really don't know off the top of my head.
I did my, met with my accountant last week. He brought up 2 things that he sees most of his clients impacted by. Long-term care was one of them. long-term care and pet costs,
Pet cost?
medical pet costs. Yeah,
No, no comment.
yeah, well, that's why I felt about it too.
Is this
You know
best?
something about that, then you have an 18-year-old poodle at home.
Not 18, but yeah. Any questions on the product, concepts, sales concepts? You guys understand this?
They have one you can pay for with an annuity also, I think. One America.
That's kind of what this is. There's also, so there are, outside of this, there are the income annuities, like Athene, the Pro Ascent 10, or the American Equity one. They have long-term care features, which basically, if their income is going to give the client a regular, let's say $30,000 a year for income purposes, for long-term care purposes, it'll double the benefit until they exhaust it. Yeah, I'm not in love with those. I'm very like, it's right.
IUL is a good option. It's relatively cheap.
Guys, this is, yeah, I mean, so let me just show you, and we had a really analytical client, and this client was, so this client, husband and wife, they're in their late 60s, moved to the US, call it 20 plus years ago, and didn't have many assets here. They had, let's say, a half a million, 550 in 401k. She's a dentist, pediatric dentist. And it's her own practice, and the husband, manages the office, so the operations of the office. So for a husband and a wife to have 550 of 401k money, and the value of their home that has a loan, and the value of their business, it's not, they're not really set up for retirement, right? And if I show you, so this was the existing, I'm just removing their names here. If I show you, this is their existing, what they have in life insurance. So they're spending collectively $25,000 a year on these policies, of which they're term policies. Their kids are off the payroll, right? They're nearing, I don't want to say the end of their careers, but they are entered a different point of their life. Where in the beginning, did they have a need for this when the kids were on payroll? Yes. Now, why are you spending $25,000 a year on this? You need to reposition the money, right? You need to reposition where you guys are spending that money. So we talked about juicing up what they are saving for as long as they're going to continue to work, whether it's with us or somebody else. And also, if they were to go on claim for long-term care purposes, what would they do? And unfortunately, they lived this with their parents, and their parents lived well, both sides, husband and wife, lived well into the 90s. So when we brought it up, the husband's very analytical, and he's like, I'm worried. I'm worried. So we had a bucket of $25,000, call it $26,000 they're already spending this. It's where am I deploying it, right? So after all was said and done, I've shared this with you guys in the past. I don't like going into illustration land with clients. You go to illustration land with clients where you're going there with 5, 6, 7 different illustrations. They get glazed, they get glazed deer in headlight look. So it took us 3 meetings. So after meeting 1, so we had 1 call, and then we had 1 live in-person meeting, and they got approved for the plan because they saw that there was a need. So we were doing the Mutual of Omaha IUL, and then during the finalization meeting, they were really worried about the unlimited cost that they would incur for long-term care purposes. So then we got them approved for One America. Okay. To make a long story short, when it was time for them to make a decision, instead of showing them, here's illustrations for IUL, here's illustrations for One America, here's the da 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 da, we put together, if I was them, based on what I know, what are the options that I would think of and why? And we had one piece of paper, if you guys can see this over here, that we showed them. Option one is you go with the one, and with this, guys, we wanted to take that $26,000, $25,000 and deploy some of that money to save and invest, and they should have been spending and saving a little bit more, not spending, but investing a little bit more for future investments. So we said option one, you guys were really worried about the unlimited benefit for the cost, right? So we do a $6,000 a month with a 3% inflation for 20 years. The cost is $24,000. And this is together, husband and wife, right? Option two is we do a $3,000 a month One America plan with a 3% inflation. The cost is $13,500. Option three is forget the unlimited benefit. We go with Mutual of Omaha, $300,000 face amount with a 2% long-term care rider, gives them each $6,000 per month to use for long-term care purposes. It's $14,598. Option four is One America, $6,000 a month, no inflation. It's $15,000. So for those that want to see the cost of inflation, it's almost a $10,000 a year difference for the same thing. And option five, we said we do half with Mutual of Omaha. So we do $150,000 IUL on each of you with a 2% inflation rider that gives you each $3,000 a month. That cost is about $7,200 a year. And then we do a $3,000 no inflation rider with One America, and it's $7,500 a year. And the cost is $14,851. Guess which one they went with? They did 5B. So instead of 150, they wanted to do 200. So they each did 200, 200, 3,000. It was about 17,000 a year. And we had 9,000 for them to invest more into, and they should be investing more, but that was, she had a piece of paper, I had a piece of paper, he had a piece of paper. And we went through all of this. I had the illustrations if we needed them, but not, do you guys understand what I'm saying? I would have had to have 1, 2, 3, 4, 5, 6, 7, 8 different illustrations to show them. Simplify it down, it helps them. And we just, this was, I put it up there, but this is what they wanted, but it was high. He was leaning towards this. I kept reminding him, remember what we're looking to do is reposition some of the assets into the other things. This was true. So we got really to the same thing based on that. For international benefit, this also came into play here, right? So for people, South America, right? People have families that maybe want to go to South America to get care. On One America, they can get 50% of the benefit to use internationally. And then with the Mutual of Omaha, depending on how they trigger the policy and what's there in cash, they could use really all of it for that purpose.
From a practical standpoint, if you go on claim with using 2 different companies, that costs a lot.
Yeah. I mean, the whole thing was we killed really 2 birds with 1 stone, which was they have a $400,000 bag of cash. They also had a want for permanent insurance, life insurance. They wanted to save some money, which they're going to do in a brokerage account. But this one was basically paying for an unlimited period of time. So if they were going to go on claim, depending on what type of claim, how much they need, if I have a flood on my house, do I have to go and claim it with homeowners? I don't have to. I could cash self-pay, right? At any point in time, if I have pictures, if I made, all the facts that I needed to go on claim, can I? Yes, right? What I was going to say is depending on what the claim was, they would be using the Mutual of Omaha first or that one that has an unlimited benefit, depending on the type of claim. It's like having a disability policy from 3 different companies. You're able to do it.
Yeah, but this is reimbursement, right?
Correct. Correct. But you're gonna have one they're gonna trigger one first. They should trigger one first, and then the next one.
A supplemental policy.
Well, I know what he's saying is if they go on claim and then they file the claim with both companies, who's gonna cover what? Right? Now, if they don't need all of the money, why would they trigger both? They wouldn't. Right? If they needed a portion, what I would do first is trigger the One America plan because it's an unlimited benefit, and then trigger that one. But if they needed the total sum of $6,000 per person, they have to trigger both policies. I understand what you're saying. If they only needed $3,000, why trigger both?
Do you think that the accelerated benefits rider makes more sense for those people that plan to receive their care outside of the United States?
I mean, you're talking about the One America policy?
No, I'm talking about just the accelerated, like the critical chronic, the accelerated benefit rider on a regular IUL from Ohio National.
It can, but the One America one is clearly stated that if you go on claim and you're using it for international purposes, they're able to use $1,500 per month per person for care. They're able to do that. That's what I'm saying. Depending on the situation, it may make more sense to have something like that.
Because I've had clients say to me, well, I'm going to retire to the Dominican Republic, or I'm going to retire to wherever.
Right.
So this would not be the best suited policy for them.
Why?
Because they only get half of it.
But they also have this that they can have and use that way.
Oh, with the accelerated.
Right.
Oh, I got you.
Right.
Oh, yeah, 'cause that's on.
Right. And I'm just throwing that out there for, again,
But according to what I hear, if you go to Colombia for half the price anyway.
Correct. Well, that's correct.
That's where they're gonna.
At least half the price. Right. That's exactly right. That's, again, it's and you could sit there and try to solve, I should say, until you're blue in the face. But when you're going through options, at least for me, when I'm going through options, whether it be long-term care or whatever the carrier design is, I like to dumb it down this way because it's a quick menu of yes, 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 no, and then you focus on one. And he said, I like option 5, but I want option 5B. Anyway, target market. So you guys understand the difference, right? Do you understand how to get them to think objectively, which is showing them what the cost is, meaning if they put the same amount into a brokerage account or a savings account, what that break-even point is. You guys all know how to do that using the time value of money calculator, okay? Standalone, we already went through that. That IUL we went through. One America we went through. Who's the target market? More, it could be retirees. It's pre-retirees, single men or single women, people with no family or people with family, because there's different ways to think about that. People living through this or having lived through that. Larry's clients, right? They own a business. They're in their mid-50s. They're living it now. The wife's husband, the wife's father lives in their home with them. They pay, the husband and wife pay $1,000 a week for care for her dad. That's $4,000 a month. That's actually 4.3 months is $4,300 per month out of their pocket that they're spending on this. That's for him, right? So why did they sign up, or why are they doing it? Because they're living it. But people usually in their 50s are going to start to think about it. And I'm not, guys, don't hold me to the age. I'm just trying to give you some facts. But regardless of age, anyone living it or having lived that is aware.
The easiest question you can ask any of your clients that you meet with to talk about any of the products and solutions that we offer is, do you and your family have a written long-term care strategy? Or what is your family's written long-term care strategy? And when you get a client that says, well, my kids will take care of me, the next question would be, have you had that conversation with them?
Is this off? No. No. No, I was just thinking there's something I was going to bring up. I forgot. Questions? People, so again, back to the self-insuring thing. Somebody that could self-insure, why even roll the dice in doing it? When I went through the numbers with that guy, with Larry's client, I went through the math. He's like, you're right. He goes, yeah, makes sense. Let's do it. Especially when, depending on how you design it, it's a deduction when they do their taxes. And if it's a C corporation, 100% of the premium. If it's a business, if it's C corporation, 100% of the premiums are deductible. And they can discriminate against who they give the plan to, meaning it doesn't have to be offered to every employee. That's it. There really is no questions. I mean, we went through a lot of content. Good? Shut it.